Have you guys ever found yourself being frustrated over your trades, getting stopped out by either a few weeks or by a long week? Well, you're not alone. In this video, I'm going to be diving into the reasons why market manipulation occurs and how you can do your best to counter it.
Firstly, you need to understand that there are large institutions out there that can actually move the markets. But where do they get their liquidity from? Yes, the retail traders, you and I. So in order for the large institutions to get their order in, they will move prices to where the retail traders stops are resting at, forcing a fake out before moving price move to your intended direction. This is the process of market manipulation and stop hunts. That is why it's very important for all of you to understand about the concept and theories about liquidity pools. It is important to understand what kind of liquidity pools there are, where are they located at, so that you can prevent yourself from being a target of stop hunts which are being targeted by the institutions. Now take a look at this illustration over here. We can already identify quite a few areas whereby we can see this external liquidity level being taken out over here. It can be a previous weekly high, previous monthly high, previous yearly high, previous daily high. Whatever it is, it was an external liquidity level that was a key level, and hence it was what it got targeted. So all the stops that were resting over here has now been taken out by this price action over here. So their targets may have been lower, but because of this price action over here, now they are out of the trades, and then now the trade will go into their intended direction. We can also see over here that price has been consolidating, so maybe the retail traders would deem this area as a level of demand and prices are ramping up, trying to break out in whichever direction. So over here, price finally breaks out. So for range traders, typically they will enter off the pullback that the market gives off the level that it broke out of. So from here, we will enter off this pullback, and then we just aim for all the liquidity up here, right? But we put our stop loss here, which is where the retail traders would typically put it at. And what happens is that even though price created a higher high, higher low, higher high, price came back all the way down just to take out all the stops that are resting over here before making the actual price movement to your draw on liquidity over here. Was this your fault? Yes and no. It was your fault for failing to identify a potential stop hunt, and also you did not give your stop loss room to breathe. Maybe you can reduce your risk to reward ratio by just increasing your stop loss so that you have a higher chance of not getting stopped out by the large institutions. So even a 2 risk to reward is decent compared to having a 5 risk to reward, but then you get yourself stopped out before even getting the trade. The same goes for this level over here, so just apply all the concepts the same way and you'll be good. Now let me show you guys an example of a high time frame external liquidity level being taken out. We can identify this level as a level of rejection because prices were just consolidating at these previous O highs before making the move downwards. So all these levels probably have stops resting over here. So naturally prices would want to come and take this level out. Let's go into a lower time frame on the 4-hour. So we can see that prices is consolidating here, refusing to go higher, which probably means that this level of rejection is a heavy level of supply. So there are no more buyers around this area, it's mostly just sellers, right? So as a trader, you want to be looking for shorts in this scenario, right? Shorts are favored over long due to all the confluences that are telling you to go short. So I want to be looking for a break of market structure confirmation to go for a short, right? Because I see that price has already rejected here for a couple of days, and then he rejected here as well and here as well. So over the course of about a few weeks, price has rejected this level for, I don't know, 4 or 5 times. So once I see a break in structure, I want to go for a short because I would assume that all this level of liquidity on a high time frame has been taken out. But let's see what happens over here. So over here, we can see this break over here, right? So I'll be looking for entries over here. So I'll enter off of this level of inefficiency over here. I put my stop loss around this level and I aim for a 1, 2, 3 RR over here. Let's see whether I can get a fill in. So over here, that's where I got my fill in. And over here, I got stopped out. Why? Price already broke structure, but price came back up again just to touch this high time frame level of external liquidity level, because previously it was just consolidating here. But the institutions wants to take more sellers out of the market first before making the actual move down, right? So my short trade got taken out of the market. So now I'll probably just sit around. So this is one example of getting stop hunted. You think that price is done taking out all the external liquidity pools, and then the market just gives you a middle finger and take you out of the market. That's how the market works, right? It sucks. And let's see whether the trade will play out. How is it so accurate that right after they take out this level of liquidity that I was eyeing, right? And then price straight away went down with a huge momentum. So what I didn't anticipate is this market manipulation occurring before entering a short position. Even though based on the price action, it is still validated, but I just didn't anticipate. And sometimes this just happened and it's just unfortunate. But if you're confident enough, it should not deter you from re-entering into your trade somewhere here. So here's my second example. As you guys can see, we are in a sort of a downtrend, but price has been raging in this level and we are breaking up higher. So I'm going to be looking for longs because I see that prices has been consistently breaking. And you can see how this price just bounced off this breaker level over here, right? So we see this huge momentum candle that got up. So obviously I'm going to be looking for entries. I can see that this level consists of my inversion fair value gap, but there's also another block over here. And this is my first candle, second candle, third candle, which forms this level of fair value gap over here, right? So I'm hoping for prices to feel this level of inefficiency before getting all this draw liquidity over here, right? So I enter for a trade here around maybe like the 62% level, and I'll put my stop loss here because if price goes over this level, the trade is probably invalidated, right? So I'll just aim for whatever liquidity is up there. So let's say I just put a limit order like that, and then I just wait for prices to fill, and let's see what happens. Do you guys see what just happened? I just got stopped out and then price just immediately went up. As you guys can see, my trading plan was not wrong going into this trade. What was wrong was that I did not anticipate a potential stop hunt of my stops, and then it happened to me. I got stop hunted. I got manipulated by the markets. This is another example of what happens when you don't anticipate for a stop hunt to happen, right? Typically, if the first candle of the fair value gap gets taken out, it probably means that the trade setup is wrong. But that's what they want you to think, right? So to play it safe, I would have my positions here, right? And I also have positions here to ensure that my trades are evenly spread out. I don't have everything on a single trade, so that if I get stopped out on one trade, I still have the other trade that hasn't gotten stopped out yet that I can write up. Okay, so this is one method that I use to prevent getting stopped out fully, right? I enter multiple trades for different sizes. So the question you have to ask yourself is, would you rather have a single trade set up which has the utmost potential for a full take profit, but then you also have the potential of getting fully stopped out? Or would you rather spread your trades out to multiple different trades that add up to the same amount that you would have had on a single trade, but now you don't have the possibility of getting fully stopped out by a single wick of the candle? Even though you may not get all your trades filled up, you prevent getting fully stopped out, and that's what matters. So I want you guys to take that into account. Now lastly, you guys really need to give your stop loss room to breathe. You need to be reasonable where you place your stop loss, right? Stop loss are meant to be there to prevent your losses from getting too much, but you also can't put it at a level whereby it literally has zero room to breathe at all. Alright, so we take a look at this chart over here. So over here we can see that prices are making higher highs and higher lows. So let's just say I enter off this level of pullback, and then I put my stop loss at this level, aiming for a draw on liquidity over here, getting my 3RR trade over here. This is a reasonable stop loss, right? And let's just say that you want to play more safe. There's nothing wrong with having more room for your stop loss to breathe, right? But lowering your risk to reward. Because who is to say that price will not come back down here, take out your trade before going up? So you can't even get whatever take profit you had, right? But if you had done the 2 risk to reward with a larger stop loss, you would have cashed this trade. You get what I mean? So sometimes if you feel that price is a bit too sus and you feel that you might get stopped out by the institutions, you can lower your risk to reward and give your stop loss more room to breathe. So you just sacrifice profits, but you prevent yourself from getting stopped out of the trade for the same amount of risk. So please do not sacrifice your stop loss so thin just because you want to get a higher risk to reward. You sacrifice your stop loss but then you get stopped out easily before the trade plays out. It's not worth it. Alright, so always give your stop loss room to breathe. So I'm just going to give you guys one last example to wrap this up. So we can see that price has bounced off this strong macro level of support. So now we're going higher, and I can identify this level as my draw on liquidity. Go on to the lower time frame, and over here you can see price breaking. This is my breaker level. So I have a question for you guys. Would you guys rather enter off of this trade? Let's take this trade as a trade A. Right, this is my target over here. I'm gonna put a different color for this trade. So let's make this a blue. Would you guys rather enter trade A with a 8.5 risk to reward ratio with the same draw on liquidity in target? So it just feels this level of inefficiency, and then I put my stop loss at the first candle of the fair value gap, right? Or would you guys rather take trade B, which has a lower risk to reward of 3, but I have a larger stop loss, right? Go and take a few seconds to think about it, or you can pause this video and let's see what happens over here. Both these trades get filled off this level. Trade A got taken out. And over here is where our take profit is. So over here, we have the same draw on liquidity, right? But we just had different level of stop losses. So do you guys understand what I mean by giving your stop loss room to breathe? Yes, both of these trades are good, but what's even better for trade B is that you have more room for price to play because you are knowledgeable in the fact that market manipulation occurs, stop hunts occur. So you don't want to give yourself that chance that you might get stopped out of a good trade, because this is a good trade. You are riding the bullish trend up, right? You don't want to get stopped out by stupid mistakes like this. I hope more of you picked trade B compared to trade A after what I just told you, but this is how you guys should be looking at things from here on out. You always have to anticipate market manipulation occurring and having a stop loss taken out, because that's how the markets work. Alright, the markets is not fair, and you have to trade it with this mentality. Alright, that's all I have for you guys today. I hope this video was insightful enough for some of you, and I wish you guys all the best in your trading.